Kevin. Thanks, and Happy New Year, everybody. So yes, I'm a CPA. I've been in practice 25 to 30 years. I've been saying 25 for a bunch of years, so it's probably closer to 30 now, showing my age. And I've been doing this for a very long time. And about 6 years ago, I I started specializing in the real estate space, helping both realtors as well as real estate investors. And from there, I also got very involved with international, because as many of you know, South Florida, especially Miami, is a big hub of foreign investment in real estate in the United States. So I'm well versed in international taxation as well as it relates to real estate. So my main focus today is going to be on entity selection. You've all heard of many things. You've all heard of PAs and LLCs and having a nice shiny PA behind your name on a business card. But what exactly does all this mean? And I'm sure you've all heard from they say this or they say that, the way it should be done. But I'm going to tell you how it really should be done. So there's a lot of days around, and most of the days don't really know what they're talking about. So I'm going to steer you on the right path and make sure you have a good foundation for success, as it relates to your business structure as a realtor. So we're going to start out, and I'm also going to go over some pitfalls and some mistakes that I see all the time that could easily be avoided with the right information and the right guidance on the onset to save a lot of headaches on the back end, and also taxes and money. So, you're all here you work very hard in your real estate business. And the idea is to keep as much of that as you can in your pocket and not pay it out to various tax jurisdictions, Uncle Sam, our silent partner, as well as Florida for certain taxes as well. So we're going to get started. By default, as a realtor, you're considered an independent contractor. And as such, you get paid with a 1099 that you receive at the end of the year. That 1099 is then reported on a Schedule C on your personal tax return. A Schedule C is nothing more than a business schedule that becomes part of your personal tax return. And that's where you report self-employment type income. Whether you're a realtor or you have other types of self-employment income, you reported the gross income on a Schedule C, or your various line items of expenses. Then you have your net profit or loss, and that profit or loss then gets to be part of your other income items on your tax return. So that's if you don't do anything. You just, by default, you're an independent contractor and you file a Schedule C on the personal return. So what are the benefits of that? Well, the first benefit is that it's easy. You don't have to do anything. It's just default. You don't have to do any kind of separate filings. You don't have to do any kind of separate registrations. You just get your 1099 at the end of the year, and hopefully you've been keeping track of your expenses throughout the year and not have to just scramble around and do it in one shot. And that's another topic we could speak about as far as bookkeeping goes. But that's the main benefit of not doing anything, just being a sole proprietorship, Schedule C in your personal return. Now, what are the downside? The one of the downside is as a self-employment type income, that is subject to a tax called self-employment tax, which is an extra 15.3% of that net profit. So, and that's in addition to your federal tax at whatever tax bracket you're in. So if you make $100,000 in net profit from your real estate, that's another $15,000 of tax that you're going to owe if you don't do anything. The other intangible problem with, I don't say problem, but the intangible downside of that type of structure is that there's more for the IRS to look at from an audit standpoint. So depending on how aggressive you are with your deductions, whether it's meals, entertainment, well, there's no entertainment anymore. You can't deduct entertainment, but whether it's meals or your auto expenses or your marketing, depends. So there's more of a chance of having an audit risk if you have a Schedule C on your personal tax return than other forms of business structure. Okay, so that's a Schedule C if you don't do anything. Now, you've all heard, like I said at the beginning, you've all heard of LLCs and PAs. So let's start off with an LLC. So what exactly is an LLC? Very simply, an LLC stands for Limited Liability Corporation. And what that is in effect a hybrid between a partnership and a corporation. And the main purpose of having an LLC type structure is mostly for liability purposes, not so much from a tax standpoint. So if you set up an LLC for your business as a realtor, for your real estate business, and it's a single member LLC, in other words, it's only the only one member of part of the entity, then that's considered a single member LLC. And that's what's called a disregarded entity with the IRS, meaning that what that means is that from an IRS standpoint, it doesn't exist. So you have absolutely zero tax benefits of having a single member LLC set up. And that's another they say, oh, go set up an LLC. And so I don't know how many times the client comes to me at the beginning of tax season and, hey, Don, I set up this LLC at the beginning of the year. I'm going to save a bunch of money now. Well, sorry, but no, you're not going to. Because like I said, a single member LLC is not going to give you any tax benefit whatsoever. The main purpose of that is if you're a real estate investor and you have multiple properties in a portfolio, you can set each one up in a single member LLC so that if one gets sued, it doesn't affect all your other assets. So again, it's done for a liability purpose, not for tax purposes. Now, with that said, the next level up that you've heard about is a PA. So what exactly is a PA? A PA stands for Professional Association, and it's nothing more or less than a corporation. So when you set it up on Sunbiz or if you ever set up any corporations, it's simply a corporation as opposed to an LLC. Now, the reason why it's PA instead of Inc. or Corp at the end of the name is because certain professions are required to use PA in their name of the entity, and real estate is one of them. Architects, lawyers, doctors, similar thing. Use PA. Now, one of the things that I see all the time, as far as mistakes go, is that with the per the DBPR, the name of your entity, and that applies whether you're an LLC or a PA, needs to be exactly the way your name is listed on your real estate license, comma PA or comma LLC. If you don't do that, you can't use a name on the greatest realtor in the universe, comma PA or comma LLC. That's not going to fly, because what you need to do is once you set up the entity, the next step is you need to go to the DBPR and you need to update it with them. And then once that is done, then you need to update it with your broker. So again, you set it up at the beginning of the year, you come to me, greatest realtor in South Florida, comma PA, Don, save me money in taxes. Well, sorry, it's not going to help you. It's not going to do anything for you because number one, obviously you didn't take the next step in going to the DBPR, because if you did, they would have kicked it back. And the next step after that is updating it with your broker so that your closings go to your new EIN number, to your PA, as opposed to your social security number. And if you don't do that, you're going to get a 1099 at the end of the year, just like it doesn't exist, and it's not going to do you any good. So these are a couple little things right now that I see all the time that can be avoided just having that information right there. So if you have a takeaway already, if you're going to do it yourself, if you're going to set up a PA or an LLC, make sure it's the right name. And it's a real hassle changing it, because if you don't do it right, then you're going to have to change it. You have to do a name change with the state. That takes time. And then you're going to have to update it with the IRS, because one of the steps is getting what's called an EIN number, which is kind of like a social security number for a business entity. And then that number is associated with a name. So if you do a name change with the state, you also have to change it with the IRS. So it's a big hassle that could easily be avoided by doing it right, initially. So let's say you set up that PA. The next step is, by default, when you set up a corporation, you're what's called a C Corp. A C corp is a separate entity, just like any other corporation, except that it's taxed at the corporate level. So depending on what your what your income is, it's taxed. Well, actually, a C corp has a flat rate right now at 21%. So the corporation itself is taxed, not the individual shareholder. The problem with the C corp is you have what's called double taxation, because the corporation is taxed at its tax bracket. Then as a shareholder, when you take money out, then you're taxed again as dividend income. So you have that double taxation. So a C corp, for your purposes, as far as a real estate business, is not the way to go. The key is what you need to be is what's called an S corporation. What an S corp is a corporation that's elected to be taxed as an S corporation. And what that is there's no tax at the corporate level. With the net profit or the loss flows through to the shareholders on a form called a K1, and then becomes part of your personal income, or if it's a loss, it offsets other income you might have on your personal tax return. So with that said, the advantage now, why have a PA, a corporation, versus being a straight Schedule C on your personal return? The difference is that net profit that flows into the personal return from an S corp is not subject to that self-employment tax that I spoke about earlier, that 15.3%. So let's say the same example, you have that 100,000 of net profit after all your expenses, the same 100,000. Now that 100,000 then flows into your personal tax return, and it's still taxable income of 100,000, except now you're not going to get hit with that self-employment tax at 15.3% or another 15,000. That's where the savings comes in. And depending on your income level, obviously the higher your income level, the more savings you're going to have. If you double that to 200,000, now you're looking at $30,000 of tax savings. So it could be very, very significant. Okay. Now, with that said, there is a caveat, because there's always a catch to everything. As an owner, as a shareholder of an S corp, you're also considered an employee of the entity individually. Someone is providing services to that entity to produce that revenue. That someone is you. So you're supposed to pay yourself what's called reasonable compensation, which in effect is payroll. W-2 at the end of the year, payroll reports done quarterly, taxes taken out, the whole bit, just like getting paid from any other employer. Now, the advantage now is that you don't have to have that payroll. Okay, let me back up. The payroll now is going to be a portion of what your net profit is, and becomes an expense to the corporation. So now let's use the same example of that 100,000 of net profit, and let's say you're going to take payroll out of 50,000. Now that self-employment tax is going to be, self-employment tax is the same thing as payroll tax. When you get paid as an employee, you get Social Security and Medicare withdrawn from your paychecks. That Social Security and Medicare, also known as FICA, is withdrawn at a rate of 7.65%. Your employer then matches the other 7.65%. And if you add those two up, that's where the 15.3 comes from. So when you're self-employed on a Schedule C, you're responsible for that entire 15.3%, as opposed to an employee where you only have half of it withdrawn from your paycheck. Now, which is payroll tax. So when you have an S corp set up now, and you take payroll out of the S corp, you're paying payroll tax now on that payroll portion, but not the full amount. So going back to the example, let's say you had 100,000 in net profit and you show payroll of 50,000. Now you're only going to pay that payroll tax or self-employment tax on the 50 versus the full 100 if you didn't have the S corp set up. So now you're looking at about 7,000 of payroll tax / self-employment tax versus 15,000. So you're basically cutting it in half. And again, the higher your income, the more savings you're going to have. So you're not going to get a full savings of the full 15,000, but you're going to cut that in half. And half of the payroll tax, the 7.65% that the corporation pays, because you're both, you're the corporation and the employee, you get a deduction for that as well. as a business expense on the corporate side, on the PA side. So that's where the main savings is with an S corp, is that self-employment tax or payroll tax. Now that I use the example of 50,000 on 100,000 of income just to keep the numbers easy to explain to you, how it works. But that's not. It could be 40,000. It could be 35,000. Depending on the circumstances. Also, another thing I'll bring up now is that when you have payroll set up as a corporation, as an S corp, from a financial planning, from a retirement planning, also from a tax planning standpoint, you could also now set up pension plans for your own corporation, for your own PA. You can set up a solo 401k. You can set up a SEP plan, and now you could defer income and further save money on taxes, while at the same time saving for retirement and start building up that retirement for yourself. And it's a great strategy. And I could do another class just on retirement plans, for small businesses. But I just want to touch upon it now, that's also another advantage that you have by having the corporations set up. So going back to the LLC versus the PA, I mentioned that the LLC, if you come to me beginning of the year in January, February, say, Don, I set up this LLC. I did the correct name, which is great. I have the EIN number, but I'm an LLC, single member. So like I said earlier, there's no tax advantage. It's not going to save you any money. You can retroactively go back and convert it to an S corp classification, as long as the entity is set up in the same year of the tax year that you're filing taxes. So we're doing 2024 tax year right now. That's due this year. It's due by April 15th. If you're a corporation, due by March 15th. So if you set up this entity anytime in 2024 and haven't filed a tax return yet for it, then you can still retroactively, there's ways of doing late elections, of having the S corp retroactive to the date that you set it up for this tax year. Okay. Now, if you set up that LLC last year, being in 2023, and you already filed a tax return as a disregarded entity on a Schedule C, you cannot do that. You can still convert it, but the earliest you can convert it is as of January 1st of this year, and you have till March 15th to do that. So if you come to me, this now for 2024, and you set up an LLC the year prior, so you have this whole year, you can't retroactively go back. You've got to file it, unfortunately, as a Schedule C for 2024, and then we could plan ahead for this year for 2025 as an S corp. And depending on your income, like I said, it could be a substantial amount of savings of having the S corp set up. Okay, so those are things that I see all the time. That, again, with a little planning, a little bit of knowledge, it could save you a ton of money on taxes, and and keep more of your money in your pocket instead of paying the IRS. Also, the intangible benefit of having the separate entity set up as well is, from an IRS audit standpoint, a small corporation is much less likely to be audited than a Schedule C on the personal return. So again, depending on how aggressive you are, all your line items of your expenses are reported on a separate tax return. For an S corp, it's called an 1120S. And the only number that shows up on your personal return is that net amount that flows through from the Form K-1. The IRS doesn't see any of your line items of any of your expenses. All that is reported on the S corp return, on the corporate return. It's a separate filing. So the chances of that being audited versus a Schedule C on a personal return is much, much less. So from that standpoint, one of the intangible benefits is also less likely being audited by having the S corp set up, which is good also. And again, depending on your record keeping, depending on how aggressive you are with your expenses, it can make a big difference for you. Okay. Let's see what else here. I touched upon it briefly as far as bookkeeping goes, accounting goes. some people think, hey, Don, I want to set up an LLC or I want to set up a corporation because I want to write off all my expenses. Well, it doesn't work that way, because what you write off in expenses or deductions has no bearing on the type of structure that you have set up. It makes no difference. Whether you're a straight Schedule C on a personal return, or whether you're an LLC or you're an S Corp, you're allowed to deduct what's called ordinary and necessary business expenses relative to the type of business that you're in. As a realtor, obviously you have marketing expenses, you have association dues, you have open house fees, you have marketing, you have auto expenses. Okay, these are expenses that you could deduct regardless of whether you're a Schedule C on a personal return or whether you're an S Corp filing a separate return. It makes no difference. The main thing is that it's got to make sense for the type of business that you're doing, and you should have some backup and records to it. Now, getting back to the bookkeeping accounting, you should, as a corporation, it's a separate legal entity, so you're supposed to have a separate bank account for the business in the name of the corporation. And all your deposits should go into that account. All your deductions should go out of that account. Don't use your business account as a checkbook for your personal expenses, because then you're commingling the funds. And one of the advantages, besides the tax advantages of having a corporation set up, is you do get some limited liability by having the corporation set up. If you commingle your funds, a good attorney would go in there and say, well, you're commingling your funds. It's nothing more than what's called an alter ego of yourself personally, and they do what's called piercing the corporate veil, and you don't get that liability protection. So it's very important to keep it separate for that reason, from a liability standpoint, and also from a bookkeeping tracking standpoint. It makes it a lot easier to just have your business expenses in your business account and your personal expenses in your personal account. Now, you may be asking, how do I get money out of the business? One way that I mentioned is in form of payroll. The other way with an S Corp is called distributions. What a distribution is you're simply pulling money out of the business account and moving it into your personal account, whether it's via check. I mean, no one really uses checks anymore these days. It's most likely it'll be a transfer, an online transfer from your business account to your personal account. That's called the distribution. And it's not taxable, because what that is in effect is you're taking an advance against the profit that you're going to be paying tax on at the end of the year when the corporate tax return is filed and you get that K1. So if you get a K1 for 100,000, which represents the net amount after paying out all expenses, and you pull $100,000 out of your business account as distributions, you're not paying tax on that 100,000 what you're paying out. You're paying tax on that 100,000 of net income on the K1. It's a little bit complicated, and it's kind of a concept hard to grasp, but I'm not expecting you to become an accountant, become a taxpayer, but I just want you to be exposed to it so you have a basic idea of how it works with an S Corp and pulling money out. Okay, so that's called the distribution. And that comes into play in determining how much payroll to show out of the corporation also, because the IRS looks at your distributions, and let's say you have 100,000 and they're profiting, you don't do any payroll, you take all of it out in distributions. That's a big hot button with the IRS, and there's a good chance you may get audited. And if you do, it's not good. It's a big hassle. It's going to cost you a lot of money, because the IRS will then go back and reclassify part of those distributions as payroll, and then you're going to be responsible for all the late fees of the payroll reports that you should have filed, as well as all the payroll tax that you should have filed on the payroll portion. So you don't want to do that. It ends up costing on average about 2.5 times the amount you would have initially done it. So my advice is to show the amount that you should be taking out in payroll versus distributions, and not be greedy, but show the minimum amount that you need to satisfy the IRS, and you don't get hit with an audit. And you're still saving a bunch of money, whereas not having the S Corp to start with. So that's how I advise my clients. And it's kind of a balance between not taking out too much payroll, because that defeats the purpose of having the S corp. You're going to pay that payroll tax, but taking out enough so that it doesn't trigger an audit by not taking out enough payroll and only taking distributions. It sounds very complicated, but it's not. Well, it kind of is, but I take care of all that for you, so you don't need to worry about how much to take out, what the payroll reports are. Either myself or if you have your own accountant now, they can handle all that for you. But what I do is not just preparing the reports, it's also guiding you of how much payroll to do. And what I typically do is meet with my realtor clients on a quarterly basis, and based on the prior quarter, the payroll reports are due each quarter, the month after each quarter. So what I'll do is I'll meet with the client, say, okay, what was your activity level for that prior quarter? Based on that, I'll advise them, okay, how much do you take out in distributions? And then based on that, I'll advise them, okay, based on those numbers, we should do X amount of payroll. And the way I do it, you don't need to pay yourself an actual payroll check per se. What I'll do is more of an accounting entry where I'll offset some of the distributions you already took out and reclassify part of that as payroll in your books, and then file the necessary board reports based on that. So because you're commission based, you may have a quarter that's you did very well. You may have a quarter that you're not. So it doesn't have to be the same amount of payroll each quarter. It's based on your activity level. And at the end of the year, I have some clients that only do payroll twice a year. We meet, in the middle of the year, at the end of the year, and we file the payroll for the first half of the year and then the second half of the year. So it doesn't have to be each quarter either, but the reports need to be filed each quarter, and it can be filed with zeros as well. Okay, I'm jumping around a little bit, but I just want you to be aware of that. The other thing, as an independent contractor, whether you have a corporation set up or not, you should be paying in what's called estimated payments, and that's very important. What that is when you're a W-2 employee, you have, besides the Social Security and Medicare that's being withheld from your paycheck, you also have a certain amount of federal tax being withheld, federal withholding. So at the end of the year, presumably what you paid in during the year should match up pretty much what the tax is going to be at the end of the year when you file your tax return. If you withhold more than you need to, you'll get a refund. If you don't withhold enough, you may owe a little bit of tax. But in general, it should work out just about even. As an independent contractor with a Schedule C, or if you have other types of income, you may have rental properties, you may have stock portfolios, interest, dividends, capital gains. None of that, there's no tax withholding on that. So if at the end of the year, whatever your tax is going to be, you're going to have to pay that whole lump sum in one shot. Okay. And if you spent the money during the year, a lot of times unexpected expenses may come up. You spend the money at the end of the year, you have to pay your taxes and you have no money to pay it. So now it becomes a stressful situation that's unnecessary if it's planned ahead of time, and not only stressful, but now if you don't have the money to pay the tax, you're going to have to either set up an installment agreement with the IRS, in which case they're not going to come after you for collections, but you're going to get hit with interest and penalties as long as that tax is outstanding. Or you may have to borrow the money, use a credit card. Again, you're going to pay out interest, for that amount of tax. So we try so hard to minimize our taxes and to bring it down as much as we can. Then you're going to get hit with extra penalties and interest on top of it. So it kind of defeats the purpose. So that's where the estimated payments come in, where each quarter you pay in a certain amount of tax based on your estimated amount of tax for that period of time. And I also help my clients with that as well. So you don't get hit with a big lump sum at the end of the year that you don't have the money to pay for. So that's something that's very important as well. Okay. That's basically most of my presentation that I wanted to cover. It's a good time to do it right now. It's beginning of the year. If you don't have it set up, now's a great time to do it, so you can have it set up for the full year. Unfortunately, it's too late for last year, for 2024, but at least for this year, I offer no charge initial consultations, I make it very easy. Just go to my website. I have a booking app there. Just schedule some time with me to chat. We could talk about it, and we'll see if it makes sense for you, depending on your income level. It may not make sense to set up an S corp yet. Maybe we wait a little bit. Maybe you're brand new as a realtor and you don't have a lot of income yet. Then I would recommend to maybe wait a little bit till you start generating some revenue, and then set up the S corp. Because chances are you'll have enough expenses to offset that income under Schedule C anyways when you're first starting out. So I'd rather you put the money into marketing and building up your business than putting it into setting up a corporation and paying someone like me extra money, for the setup and then the extra filing. So that I would recommend doing that. But feel free, reach out to me for that and any other questions you might have on a one-to-one basis. And if anybody has any questions now, Kevin, do you want to open it up to any questions?
Sure. Yeah. Let me check the chat. I have not been monitoring the chat to see if there's any questions. Start there. But if anybody wants to ask anything in person, just raise your hand and we'll expedite the floor to you. But while we wait for people to raise their hands, the first answer to your question, for anybody who came late, as long as Don is okay with us releasing the recording, we'll have the recording for you available next week.
Do I get any royalties on that?
I mean, I'll throw you 2 pennies, Don. We're not.
All right. I'll have my people contact your people. We'll work out a deal.
All right.
No, I'm just kidding. Yeah,
funny.
no problem.
I think Facebook sends me like $1 or $2 every quarter.
Oh, okay.
Because of the views that I generate, but it just shows you we're not quite there. But
yeah, no problem. No problem.
Awesome.
Let me say, I do see a question. What is the C Corp initial tax percentage? Was it 20? Yes, it is 21%. And that is, that's if you have a C Corp. And again, you shouldn't be a C Corp. You should be an S Corp, and there's no tax at the corporate level. Trump is talking about possibly bringing that down from 21% to 15%. That's been kind of floating around. And if that's the case, then that does actually open up some planning opportunities, depending on what your tax bracket is on your personal side. If the tax bracket from the C Corp is 15%, that may make a C Corp more interesting going forward, but that remains to be seen for now. Is it beneficial for all agents to be an S Corp, or should you make a certain amount? Yeah, I touched upon that. Generally around the mid-20s, 30,000 in net profit. By net profit, I mean after you have your gross commissions, and then you're allowed to take off whatever business expenses. I'm talking about the net between 25 and 30,000. You'll pretty much break even on the expenses of setting up the S Corp and then maintaining it. You're not going to have a lot of savings, but it pretty much won't cost you anything once you get to that level. If you're starting off and you do 5, 10, 15,000 in gross commissions, I would say, no, it doesn't pay to do it. I would wait. Okay. And so if you're breaking even, then you still have the intangible benefit of less of an audit risk by having it set up. So I would say, and then again, it depends on what you're projecting going forward and what you have in your pipeline. If you're starting off and let's say you did 25, 30,000 and it looks like you have some really good things happening, then I would say, yes, we should set it up sooner than later. It generally takes, depending on the state, on how backed up they are. I've seen it done in a matter of a few days, and I've seen them take a couple of weeks to get it set up. So depending on the state turnaround time, I would probably allow a couple of weeks on the setup for that. So if let's say you're starting off and you have a big closing coming up in about a month or so, I would say you can contact me, and then we could have the corporation set up in a couple of weeks, and you can get that commission going into the entity. So you can save some money right off the bat, with that commission, with that closing coming up. So let's see, we're breaking up. Okay.
Yeah, I got the next question, Don. How does someone depreciate a commercial building in its entirety in under 10 years?
Okay, well, that's not the topic of this, but for investment properties, commercial is depreciated at 39 years, and residential investment property is depreciated over 27 and a half years. Now, there is what's called bonus depreciation, and bonus depreciation are for components of the real estate that could be classified in 15 years or less classification, and they could be expensed upfront as either what's called bonus depreciation or what's called Section 179 depreciation. Generally, that is done by using what's called cost segregation. And again, this is a whole nother class. It's off, what we're talking about here. But there's what's called cost segregation, where what that does is it pulls out the different components of real estate to those components that could be depreciated over a shorter period of time, so that you could have much more depreciation. More depreciation brings down your taxable income. Less taxable income means less tax you're going to pay. So your ROI on that investment goes up. Okay. So I'm just going to leave it at that for now. Okay. And again, I work with a lot of real estate investors as well, not just realtors.
Okay.
What about a new agent?
Next question is, how much revenue makes it worth starting a PA?
Yeah, again, I just spoke about that. Generally, in the mid-20s, you'll break even. Once you get into, 50, 60,000, 70, 80,000 or more, that's when you'll see it generating, some nice savings from having it set up. Let's see.
I got the next one, Don. What if someone opened the LLC in August? Can they change it now to a PA?
In August of this
Last year.
2024? Yes. And the thing, you're not going to change it to a PA. Okay. It's still going to be an LLC, but what you can do is you're going to change the tax classification of the entity. So it's still going to be an LLC, but it's going to be taxed as an S corp. Okay. The key thing here is the S corp, not so much the LLC or the PA. PA being a corporation, LLC being a limited liability corporation. There's two separate types of entity structures, okay? But either one could be set up and taxed as an S corp. That's what you want. You want it to be an S corp. So you could set up an LLC and immediately set up the classification to be an S corp, the same way you've set up a PA as a corporation, because like I said, by default, you're a C corp, and then you have to elect for it to be an S corp. I just feel that if you're going to be an S corp, you might as well just do a PA. You don't need to be an LLC. An LLC, again, is more for liability purposes. If you have, let's say you have a partner, you're buying real estate, and you set up a multi-member LLC, now you're taxed, now it's a partnership return. Okay, and again, it's done for liability purposes. It's not done for tax purposes. So that's why I say the PA. But the main point is you want to be an S corp. Okay. How can we schedule a consultation with you? My situation is more reactive. Very simple. Just go to my website. My website is fallenbaumcpa.com. I guess I could put it in the chat, or Kevin could distribute it. And I'm also a platinum affiliate member of the association. My information is listed on Miami Real Estate Association website as well. And on there, it just says book me, and just click on it, and you can just set it up. It makes it very easy. Send the link through. Yeah, I'll put that in here. What's the cost to make the S corp election? Well, to do the S corp election, it's a form that needs to be filed. Generally, I charge $200 to do the election. If I'm setting it up from scratch, setting up the whole entity, I include the S election in part of my fee. My fee to set up an entity is $550, and that includes the state filing fees, setting it up, consulting to see what makes sense for you. I mean, we may set up we may have a meeting, and then we go over it, and maybe it doesn't make sense for you. So I'll recommend, no, you don't need to do it yet. Let's wait. Or yes, let's get it done quickly. You don't know how many times, a new client comes to me, and, we both wish, because I don't like paying taxes. And that's why I think I got into this business 25, 30 years ago, because I don't like paying taxes myself. Hope the IRS isn't eavesdropping here or anything, but they probably are. But what I was saying is, you don't know how many times, we both say in meeting with a new client that I wish we would have met 6 months ago or a year ago, or 8 months ago, because we would have saved them a lot of money. So it's definitely worth it, to schedule that initial meeting and chat to see, what makes sense and how I could help you. Okay, highly recommend that. Okay, so that's the August chat. Let's see the quarterly limit. All right.
Yeah, I think that's all the questions, Don.
Yeah.
So if anybody has any other questions, please put them in the chat now, or just go ahead and unmute your microphone. You can ask right away.
Okay. As far as any new tax changes for this year, there really hasn't been anything new enacted yet for 2024 tax year. One of the things I want to point out that's really important is that the big tax reform that happened in Donald Trump's last administration in 2017, most of those tax provisions are due to sunset, meaning they're due to expire the end of this year. And then everything reverts back to the way it was prior to that. And that's going to be a big change for most people, an increase in tax for most people. Chances are, I mean, the idea is they're going to want to make a lot of these provisions permanent so it doesn't expire. And that's going to be a big change. And we'll see what happens, in the next few months, to see what happens with Congress with new tax legislation that comes through. But I would say most likely, with the Republicans, controlling the House and the Senate, and Trump in the White House, chances are that there will be most of those provisions most likely will be made permanent, and we don't have to sit on eggshells and see what happens, the end of this year, to see what happens in 2026. And I'm jumping ahead to 2026, but from a planning standpoint, you have to be proactive and strategic, because what you do now can make a big difference on what happens, what your situation is, the end of the year or a year from now. So being proactive and being strategic from a tax planning standpoint is very, very important. I do a lot of tax planning. Going to someone to do their tax returns at the end of the year and bang numbers in a computer and spit out a tax return, you can go to H&R Block and do that. My value is not just on the actual preparing of the tax returns, but the guidance, the advice, being proactive, being strategic, and being by your side. And besides that, from a realtor standpoint, I'm also here as a resource for your clients. Like I mentioned, I work with a lot of real estate investors, and you don't know how many times, one of my realtor clients call me or email me, "Hey, Don, I have this client. He has a question. He's on the fence about selling either an investment property or their home, but they're afraid of the capital gains tax they're going to pay. Could you, help them out, or, either put me in touch with them, or based on the scenario, how could they save money on that capital? Are there any strategies?" And I've saved quite a few deals along the way also, on that type of thing. And you look like a hero, because you have someone as a resource, in your corner that, if a client has a question about anything tax related, then you have someone you could, reach out to quickly. And I could help you with that. I could help the client, your client with that. And it just makes it, the bottom line is we're here for our clients. You're my client, and then we have our mutual clients, where people, your clients that you work with. The bottom line is doing the best job for them as well. And I could help you with that in that regard also, in making sure that they're taken care of the best way, whether it's, suggesting a 1031 exchange, or possibly a cost segregation if it's more high value properties. If you work with any international clients, I don't know if you know what FERPTA is, but that's a withholding if you have a non-resident alien seller of real estate, to hit with a withholding on the sale of real estate based on the gross value of the property, not based on the projected tax on the capital gains, but the actual gross amount of the selling price. And that can be quite large, so there's ways of structuring it on the front end so that they get exempt and they don't get hit with that FERPTA withholding on the back end when they sell. So I could help you out with all that as well. All right.
I have a quick question, if possible.
Go ahead.
Okay.
So is there any benefit to a seller that sells, let's say, $1 million property and he
Right.
sells it seller finance with 200,000 down versus selling it for the full 1 million?
No, you still, well, you kind of, yeah. What you're going to do is it's going to be an installment sale. Okay. And the way that works is you compute the capital gains for the whole amount up front. And then what happens is there's going to be some kind of promissory note. And then when the payback, the installments of the payback comes in over a period of time, there's going to be an interest component. And then there's going to be part of the payments are going to be return of principal, and part of it is going to be capital gain based on that. It's called a gross profit percentage based on the capital gain of the transaction. So instead of paying the whole capital gain up front, you could defer it and pay it over a period of time. So in that regard, you're still going to pay the same amount, of tax over once the whole thing is paid back, but you're deferring it out. So I guess you could say that is, tax advantage. You don't have to come out with the big tax up front. The other situation, like I mentioned, 1031 exchanges. If you have a real estate investor client that's looking to sell one of the properties, but they're looking to buy another one, you might as well do a 1031 exchange and defer the gain into the new one received, and then they don't pay any tax at all. So I mean that makes a lot of sense also. If they don't need the cash, then I would recommend a 1031 exchange for that.
Awesome. Thank you, sir.
Okay. All right. Oh, there's a question there about BOI. the infamous BOI. I don't know if anybody here has any kind of business entities, or you already have a PA, you've been bombarded with third-party companies, asking you to file it for you. What BOI is it's a new thing that the government set up through the FinCEN, which is financial crimes, it's financial crimes. There's no tax involved, but it's reporting needs to be done. Initially, they had a due date of December 31st. However, that's been in the courts, and there was a nationwide injunction that deemed it unconstitutional, and it's actually going back and forth in the court system now, and it's at the Supreme Court. So it's actually on hold right now. But it's what it basically is. It's the government is looking for the beneficial owner of an entity, and that could be an LLC, it could be an S corp, it could be any type of entity. You have to submit your information with a copy of either your passport or your driver's license to the government, and that's it. There's no tax involved, but it's kind of intrusive, but it is on hold right now. For a while, it was driving me absolutely crazy because practically every other day it was on, it was off, it was on, or it was off. This court ruled that it's constitutional, and it's not, but as of right now, it's on hold. So I'll just leave it at that for now.
I'm a YPN leader. Of course I'm going to be on my laptop.
I'm a YPN leader. Of course I have a full purse.
I'm a YPN leader. Of course I'm eating before I leave.
I'm a YPN leader. Of course I'm sneaking out for showing.
We're YPN leaders.
Of course we're going to be creating content.
I'm a YPN leader. Of course I'm signing up for classes.
I'm a YPN leader. Of course I'm Cafecito obsessed.
I'm a YPN leader. Of course I'm going to crash the next happy hour.